was just kind of a 5-minute example that I think shows the power of risk pooling as part of a retirement income strategy. And this is based on the idea of product allocation that Moshe Milevsky and Peng Chen developed in the early 2000s. That it's not just systematic withdrawals from an investment portfolio in retirement, which that systematic withdrawals is taking money from an investment portfolio. But how can you combine that with different types of annuities as well? If you spend from an investment portfolio, you can spend down principal, you can spend the interest and dividends generated by the portfolio, and then the third category is a wish or a hope. You hope that you get capital gains. You hope that stocks outperform bonds, that you get a risk premium, and then you can spend, if you get this, you can spend capital gains as well. Versus with an annuity, the sources of spending, you spend down principal, you spend any interest earned on the underlying bond portfolio of the annuity insurance company manager, or if, with some types of annuities, there may be a stock component as well. So you get whatever income being generated by the underlying portfolio. And then the third source of returns is mortality credits. This is the risk pooling. This is those who don't live as long subsidizing those who live longer. This is the idea that you don't have to just build a bond ladder through age 100, but you actually get to apply the probability of survival to each age. It's going to reduce the cost of building that income stream. And so let's just look at a simple example of this to show the value of risk pooling. This is for a 65-year-old female client. I'm going to price the annuity, and she's using the society. We're using the Society of Actuaries annuity data, mortality data that I showed before, which I think is reflective of her case. She wants to plan to live to age 100. There's still a 10% chance she'll live beyond age 100, but that's where she's comfortable. And then I am going to simplify the bond market side because I want to focus on stocks versus annuities. So we're just going to use TIPS. And the long-term average TIPS rate is around 0.5% real. I'm just going to make a flat yield curve. Any TIPS that she wants to buy at any maturity, even beyond 30 years, which isn't possible today, but she'll get 0.5% real yield for any TIPS that she wants to buy. She has $1 million, and if she puts that all into a TIPS ladder through age 100, she can spend $31,060 plus inflation. This is TIPS. So her spending adjusts for inflation. And you can see mostly she's spending on her principal. She's spending a little bit of interest on that principal. If she instead put this into a simple life-only income annuity that I'm pricing from the Wade Insurance Company, because it is hard to find inflation-adjusted annuities today, but I'm pricing it based on this 0.5% real yield, so it's same underlying consistent assumptions, pricing it based on the Society of Actuaries mortality data. She can spend $43,118 a year plus inflation. That yellow is mortality credits. And if she lives beyond age 100, you see she's getting pure mortality credits at that point. The bond ladder depletes at age 100. But even if she doesn't live beyond age 100, suppose she only lived to age 75, she still is getting to spend $40% more per year for each age prior to age 100, and then it becomes pure mortality credits. So that yellow area, that's the additional returns provided by risk pooling that an investment portfolio cannot provide. That yellow area is what the stock market would need to do for a diversified investment portfolio to be able to provide the additional income beyond what the bond market is able to provide. And the probability that the investment portfolio could do that, it's not zero, but it's also nowhere near 100%. Like I think a lot of people may tend to think, oh, you don't need an annuity because you just get the upside from the stock market and you give that up with the annuity. Well, this risk pooling is really powerful. And so to just wrap this up, I did a simulation of an investment portfolio. Historically in the US, the S&P 500 has outperformed bonds by 6%. There's a 6% historical equity premium. It had a 20% volatility. So I'm going to simulate the stock market as earning 6% more than bonds. So bonds were that simplified 0.5% real yield. So 6.5% real plus a 20% volatility. And then for different asset allocations and for different time horizons, what's the probability that the investment portfolio can support what the annuity is able to provide? Now, in the case of this client, she wanted a 35-year planning horizon to age 100. So that gets us to that second from the bottom curve, cyan-colored curve. And it's important to note she can't be timid. She can't have any chance of matching the annuity if she wants to hold mostly bonds. That annuities are superior to bonds because they're longevity adjusted. It's basically a bond with a longevity component that pays out as long as you need it. So that if she went with 0% stocks, 100% bonds, she has a 100% success rate over 20 years. But before year 25, she runs out of money. So for any time horizon beyond 25 years, 0% success rate. She needs the risk premium. She needs the stock market to outperform the bond market, and she needs to have a healthy component of stocks to have any shot at beating what the annuity can do. So suppose we convince her to use a 50-50 asset allocation. In that case, you can see over a 35-year retirement, there's about a 50% chance that she can, that the investment portfolio can match the annuity. So half of the time she'd run out of money before 35 years, half of the time she still has money left. And so again, it's not a 0% probability, it's not a 100% probability, but it's showing risk pooling usually gets it doesn't get its full credit as a source of returns for a retirement income plan. Best practices for retirement really center around integrated strategies that include both lifetime income guarantees and investments. And this slide here is it's reflecting a research article I published in 2013 about the efficient frontier for retirement income. That it kind of looks like a shark fin. And on the left, so what you want to do is move to the upper right-hand corner. You want to be able to meet spending goals in bad market environments, and you want to be able to preserve financial assets. And investment-only portfolios tend to be among the worst at doing this. That the efficient frontier was stocks and income annuities. And that's really kind of the basic starting point of lifetime income guarantees work better than bonds as part of retirement income strategies when the objective is to meet the dual concerns of longevity risk and the amplified market risk.